Let us analyze Jordan's high-yield saving strategy. He moved his funds to an account paying 4.5%. Traditional accounts offer a mere 0.45% yield. He believed this tenfold increase solved his problem. From an analytical standpoint, his premise is flawed. Financial institutions still profit off his deposits. He could have captured that full yield for himself. Consider his colleague Maya's traditional savings account. She held $20,000 in savings for a year. Her institution paid her a meager $76 in yield. Meanwhile, the bank leveraged her funds significantly. They generated over $1,200 from her deposit. She accepted the $76 without understanding why. Maya was entirely unaware of her opportunity costs. Both Jordan and Maya operated under false assumptions. As a financial expert, I must objectively expose this. This is the exact mechanism retail banks try to hide. Maya followed standard conventional financial advice. She accumulated 6 solid months of emergency expenses. She deposited the funds in a massive national bank. Monthly interest deposits provided a false security. Her account yielded a 0.38% annual percentage. Current FDIC data confirms this national average rate. That equals roughly $6.33 per month in yield. This return cannot even outpace basic core inflation. Depositors rarely question how banks utilize their cash. Funds do not sit dormant in a secure physical vault. Banks immediately deploy these deposits for their gain. Let us examine the exact mechanics of Maya's capital. The primary step is issuing loans to other consumers. This forms the core business model of American banking. They pay you fractions and lend at exorbitant rates. This specific metric is called net interest margin. The average net interest margin currently sits at 3.39%. This represents the highest margin since the year 2019. Let us apply these percentages to actual capital figures. The bank earned 3.39% while paying Maya 0.38. That creates a $602 spread kept by the bank. This calculation only represents the national average. Consumer credit cards reveal significantly wider margins. The average credit card rate in early 2026 is 21%. Institutions leverage deposits to fund these exact loans. This creates an astounding 20% rate spread. Auto loans currently average around 7.5% yield. Residential mortgages sit at approximately 6.8%. Personal unsecured loans command a 12% premium. Your idle deposits directly fund these lending products. The bank earns massive multiples on your initial capital. Next, we must analyze the Treasury arbitrage trade. Banks purchase short-term U.S. Treasury bills with deposits. Current 3-month T-bills yield roughly 3.6%. The institution earns 3.6% while paying you 0.38. This is a 3.22% spread on a risk-free asset. Retail investors could easily purchase these themselves. The bank merely acts as an expensive financial middleman. They essentially charge a 3% fee for this service. Furthermore, we must account for institutional fee structures. Banks collected $12.1 billion in various retail fees. This includes overdrafts, maintenance, and ATM charges. JP Morgan Chase collected over $1 billion in overdrafts. Wells Fargo reported nearly identical fee revenues. These fees extract wealth from the very same depositors. Maya's capital fuels this exact profit-generating machine. Banks also earn interchange revenue from debit card swipes. They profit from transaction float delays before clearing. Institutions even monetize your anonymized spending data. Multiple revenue streams are built directly on your cash. The objective conclusion is mathematically undeniable. Her bank merely rented her capital for pennies on the dollar. She provided them $20,000 for unrestricted deployment. Now, let us critically evaluate Jordan's current position. He represents the slightly more educated retail investor. He successfully secured a 4.5% high yield account. His annual yield approaches $900 on that same capital. He dramatically outperforms the average retail saver. However, his strategy still contains fundamental flaws. First, the advertised rate often relies on careful marketing. Many accounts utilize restrictive tiered interest structures. The maximum yield may only apply to the initial 1,000. Promotional rates frequently vanish after 90 days. His effective annualized rate is likely much lower overall. Second, we must calculate the specific tax implications. Savings account interest triggers ordinary income taxes. This includes both federal and local state tax burdens. A 22% federal and 5% state bracket hurts. Over a quarter of his yield vanishes to tax obligations. His gross $900 shrinks to roughly $657. Third, high-yield institutions operate the exact same model. They execute the identical lending and treasury strategies. They simply share a marginally larger slice of the profits. The institution remains a middleman extracting a premium. Jordan never considered bypassing the bank entirely. Why not purchase the underlying Treasury bills directly? Let us run a comparative analysis on 3 scenarios. Scenario 1 features Maya's traditional savings account. Gross interest equals $76 before tax liabilities. She retains merely $55 after total tax deductions. Scenario 2 highlights Jordan's high-yield savings choice. Gross interest reaches $900 annually for his account. He retains roughly $657 after all tax obligations. He pays taxes at both federal and state levels at 27%. Scenario 3 involves a short-term Treasury bill ETF. The SGOV trailing yield stands at 3.95% in April 2026. This generates roughly $790 in gross annual income. The current 30-day rate generates roughly $710. U.S. Treasury interest is exempt from state and local taxes. This federal exemption creates a massive strategic advantage. The ETF investor only faces federal tax liabilities. After taxes, they retain roughly $616 at trailing yield. This ignores the heavy state tax burden Jordan must pay. Jordan's absolute dollar yield might appear slightly higher. However, bank rates fluctuate without warning or recourse. The SGOV yield transparently tracks actual market auctions. In high-tax jurisdictions, the tax exemption is critical. Direct treasury investment completely eliminates the bank. You lend directly to the government minus a tiny 0.09% fee. The issue is that retail investors lack this key knowledge. A high-yield account is merely a better seat on a bad train. As an analyst, I recommend a much more efficient strategy. First, maintain your primary checking account for liquidity. You require this for immediate living expenses and bills. We are only optimizing the allocation of your idle capital. Second, strictly identify your inactive emergency reserves. This is capital currently degrading in traditional savings. Third, Evaluate these optimal vehicles for capital deployment. Option 1 is utilizing a Treasury Bill, ETF, like SGOV. You execute this trade through standard retail brokerages. The fund buys Treasury bills maturing under 3 months. You receive monthly dividend distributions as interest. The current yield fluctuates between 3.55 and 3.95%. The annual expense ratio for $20,000 is just $18. Your distribution successfully avoids state income taxes. Option 2 involves purchasing directly via Treasury Direct. This government portal completely removes all intermediaries. You participate in auctions without any management fees. The primary trade-off is a slight reduction in liquidity. You must commit to terms ranging from 4 to 52 weeks. Option 3 utilizes institutional money market funds. These provide daily liquidity and highly competitive yields. Treasury-only funds maintain the crucial tax exemptions. Many investors mistakenly prioritize FDIC insurance above all. FDIC guarantees protect balances up to $250,000. However, Treasury bills are backed by that exact same entity. You are lending directly to the U.S. sovereign government. The systemic default risk remains statistically negligible. Direct Treasury debt offers equal or superior safety profiles. Regarding liquidity, ETF settlements require minimal time. A 2-day settlement is perfectly acceptable for emergencies. The annual yield premium heavily outweighs this minor delay. Conventional wisdom kept Maya trapped in a failing system. Jordan improved his yield, but ignored the underlying mechanics. You must always analyze what institutions do with your money. Banks leverage your deposits for massive institutional gains. Bypass the middleman and capture the market yield yourself. If this analysis provided value, please subscribe to Visual Wealth. We will continue exposing the hidden mechanics of finance. You will not want to miss our next quantitative breakdown.